Hey guys, welcome back to another video. I'm Patrick Zimmerman, and today we will be talking about credit scores, what it is, how they're calculated, and why they are important. Don't forget to hit that like button and subscribe to the channel. For the remainder of the week, we'll be talking about strategies on how to raise your credit score, as well as the best type of credit cards you can apply for in terms of interest rates and cashback or rewards points.
Skies are clearing up.
So before we jump into what a credit score is and how it's calculated, let's talk about the benefits and why it is important to keep a high score. With a higher credit score, it'll be easier to obtain better loans in terms of interest rates. Additionally, when lenders ask for a deposit, they may require a lesser deposit if you have a higher score, because this signifies that you are more trustworthy with your money and the debts which you must repay. A higher credit score ensures that you get the best credit card deal. If you have a higher credit score, then credit card companies will often give you lower interest rates on the money you were borrowing from them. You will also be able to apply for better credit cards which offer you more rewards in terms of cash back as well as redeemable reward points. Another benefit is when you're looking for an apartment or a mortgage loan. Especially when you're looking to rent property, the landlord will generally pull your credit reports. If you have a poor credit score, the landlord is more likely to turn you away or require a higher deposit in order for you to move in. The third benefit which a high credit score offers is when dealing with your car insurance. Everybody needs car insurance on their vehicles, so this is rather important and can save you money in the long run. When choosing your insurance company, you're often looking for the lowest premiums, and a high credit score and trustworthy payment history will allow the insurance company to feel more comfortable. Similar to car insurance, something that we all need to purchase are utilities. This is electricity, water, gas. This benefit isn't a given, but if the insurance company digs into your credit history, then they may require a deposit from you or ask for a letter of intent ensuring that you make all your payments on time. Now that you know the benefits of a good credit score, let's talk about what exactly a credit score is and how it's calculated. Credit score is nothing more than a numerical representation based on analysis of one's credit reports. So credit bureaus are responsible for keeping track of statistics such as payment history, how much credit one has received, among other things. The two most popular credit score models are FICO and Vantage Score. We will be focusing on the FICO scores today as they are much more widely used than the Vantage Score. The FICO and the Vantage Score models are essentially algorithms which take in the data from your credit reports. Credit reports are sourced from 3 different major credit bureaus and then used in order for lenders to determine how trustworthy you are and your financial aptitude. The 3 different credit bureaus which keep all this information and organize them into credit reports are Equifax, Experian, and TransUnion. In addition to the FICO and Vantage Score models, these credit bureaus often will calculate their own credit score, but these are generally not used by lenders when determining interest rates, monthly premiums, and/or deposits. This is why it is not uncommon for a single person to have multiple different credit scores. They generally take into account all the same factors, but each factor may be weighted a little bit differently. So if you look up your Equifax credit score, it might be a 728, and then if you look up a TransUnion credit score, it might be 733. Again, not a huge deal as most lenders only focus in on the FICO scores, but this is something to take into account when researching your own credit score. This is a statistic from MyFico.com. I'll link it down in the description if you'd like to go check for yourself. And we are only focusing on the FICO score today because 90% of top lenders refer to FICO scores rather than Advantage scores. So this table is also from MyFico.com, and it does a really good job outlining the different credit score ranges which are available to you. If your credit score is below 580, it will be very difficult for you to get reasonable insurance rates, as well as for you to ensure that you receive loans. If you're interested in buying a house and you haven't made your payments on time for your car or your credit cards, then a mortgage lender is going to look at this and lack confidence when deciding to give you a loan. It's not the end of the world. You very well may still get the loan as long as you're not asking for too much, but you will be paying higher rates than someone with a good credit score. If your score is between 670 to 739, you're right around the average mark there. but we should all be shooting for 800 plus, obviously, as this puts us in an excellent position to secure loans, as well as earning the most efficient interest rates on things like credit cards and auto loans. Don't forget to subscribe and hit that notification bell. Tomorrow we'll be talking about one of the best ways to raise your credit score in secured credit cards. Here are the 5 factors which FICO takes into account when determining your credit score. The largest weighted category being payment history at 35%. It is very important that you make your payments on time. I myself set all my credit cards as well as my student loans to an automatic payment schedule at least a couple days before the due date. The reason this is so important is because if you just miss 1 or 2 payments, then that has the ability to greatly affect your score if you do not have a very long credit history. The second most important category is amounts owed, and this is calculated proportionally to how much available credit you have. So there's essentially 2 ways to manipulate this category. The first way is to make all your payments on time, and in doing so, borrowing less money than you're paying off monthly. As I already stated, it's important that you make your minimum payment every month in order to keep that payment history clean, but you should also be trying to throw a little extra money in so that way you're eating away at the principal which you borrowed rather than just paying off the interest accumulated every month. The second way to make the amounts owed look better would be to increase your credit limit. If you have a credit limit of $4,000 and are currently borrowing $2,000, then you're using 50% of your available credit. If you apply for a new credit card, which also gives you a $4,000 limit, your total credit limit is now $8,000, meaning you're only using 25% of what you're allowed to borrow. I don't necessarily recommend this, as having more credit cards or more available credit may encourage you to spend it, but that is an option that you should keep open when attempting to raise your score. The third factor is weighted at 15%, and this is length of credit history. This really isn't something that you can fix or change on a day-to-day basis. With that being said, if you currently have no credit, I recommend that you at least go apply for a secured credit card, which we'll be talking about tomorrow. Come back for that video, which will get you on the right track to obtain some sort of credit history. This category, length of credit history, as well as the next category, new credit, which is weighted at 10%, are factors because the credit score determines your debt management and financial fitness over time. It's important that you understand this, as if you had student loans when you went to college and then paid them all off and didn't use any credit for the next 20 years, then your credit score is going to take a massive hit, not because you missed payments or owe too much, simply because you have not proven to the credit bureaus that you are trustworthy with your money for the last 20 years. The last 10% is designated to credit mix. This is the least important in my opinion. I don't really worry about this one as much as the others because I don't recommend that you seek out extra loans simply to boost your credit score. My opinion on that may be different if the credit mix was 50% of the score, but as it's only 10%, I figure it to be a much safer decision to use credit as you need it and not simply to attempt to boost your score as much as possible. But I want to touch on why it's important that you keep up with your credit reports, or at the very least understand why it's necessary in today's society. So unless you have a money tree or are already very affluent with a high cash flow, it is likely that you will be borrowing money at some point in your life. This could be whether it's for a car, a house. Most people borrow for college. Sometimes it's just the cards you're dealt. When I was 20 years old, I tore my ACL in my right knee and I couldn't work for 6 months. I didn't necessarily want to put a ton of expenses on my credit card, but it was necessary for me in order to get by for that time that I couldn't work, much less walk. When you're looking for these loans or you need help, then it's very important that you try to secure the lowest interest rates possible. Lenders do a very good job at making it seem like they're in your corner and have your back, but in reality, they are solely there to make money from you, and they're lending you money with the intention that you're not going to pay it back. Having a higher credit score ensures that these lenders will not as easily be able to capitalize off of you simply because you needed to borrow money from them. It's also very important that you keep your credit score up because the future is uncertain and we never truly know what's coming next. Just take this whole COVID-19 pandemic as an example. A U.S. Census Bureau survey conducted the first week of July 2020 reported that 25.3% of the U.S. adult population either missed the prior month's rent or mortgage payments, or believed that they would not be able to make next month's payments. What exactly does this mean? It means for those 43 million Americans that, first off, their credit scores went down. Second off, if they did not have a high credit score when securing the mortgage, then they're going to be paying much higher interest rate in the coming months. And if they already had a credit score on the lower end of the spectrum, then it will be much harder for them to obtain tools which may help them financially in the future. It's very important that you're educated on the credit score, and in doing so, it will encourage you to better manage your loans and debts which you currently hold. If you need help getting on top of that payment history as well as the amounts owed category, these account for 65% of the score, then I encourage you to go check out my video on the second step of the total money makeover, which is the debt snowball. I would also recommend that before applying for new lines of credit, you clean up some of the existing ones which you already have. If you don't exactly know which lines of credit you currently have opened, I recommend you make an account on CreditKarma.com. This is a free resource and will pull your credit reports from TransUnion as well as Equifax, as they work alongside 2 of the 3 major credit bureaus, which you can then determine how to proceed from there. Thank you all for coming to today's video. Tomorrow, as I mentioned previously, we will be discussing secured credit cards, which is a great tool for you to improve your credit score if you have no credit history or you're in that poor credit range. You really want to take the most efficient steps possible when concerning your credit score, because once you're down in that poor range, it gets increasingly harder to secure a loan or line of credit. And as we've already discussed the different factors going into the credit score, you can now understand that if you're obtaining lines of credit with high interest rates, or worse yet, lenders won't loan to you at all, then it's increasingly harder to get out from behind the 8 ball. Don't forget to like the video and subscribe to our channel. Comment down below if you have any questions about your credit score. As always, I'm Patrick Zimmerman. Thank you for your time and enjoy the rest of your day.